That little ping from the banking app can change the mood in the room. You look down, see money has gone in, and your stomach tightens before your tea has even cooled. For a second, you are not thinking about the money at all. You are thinking, have I done something wrong without knowing it? If you like these quiet chats that help ordinary people stay one step ahead, do subscribe and keep this channel close by, because today I want to talk about something that frightens a lot of decent people in Britain for no good reason. A bank deposit feels dramatic, official, almost dangerous, but what matters is not the deposit itself. What matters is the story behind it. That is the central theme all the way through this video, so let me say it early and simply. The deposit is not the story. The source is the story. Once you understand that, a lot of the fear starts to fall away, and the rules begin to look much less mysterious. There are 6 parts to this, and each one could save you stress, tax trouble, or a very expensive mistake. First, the thing most people get wrong is the simplest part of all. They think money becomes suspicious or taxable the moment it lands in a bank account. So if a son pays back a loan, or you move savings from one account to another, or you pay in cash you already had at home, panic starts. You can almost hear the thought forming in your head that says, I hope HMRC does not think this is income. The quiet truth is this: a deposit is not taxed because it is a deposit. If the money is just your own money being moved, a family gift, a repayment, inherited money, insurance money, or proceeds from selling something personal, that is not the same as wages or business income. The tax question is always about where the money came from and whether tax was due at that point. So here is the phrase to write down and remember: the deposit is not the event, the source is the event. That one line clears up more confusion than half the nonsense people hear online. It also stops you treating every ordinary bank payment like the start of a criminal trial. If that sort of plain English untangling helps you breathe a bit easier, you are warmly invited to subscribe. I want this channel to feel like the sensible conversation many people never get from banks, tax offices, or flashy money experts. The first rule, then, is very simple. Money paid in is not automatically a tax problem. Unexplained taxable money is the problem. Second, let us deal with the myth of the magic number. This is the one that says, if you deposit more than a certain amount, 10,000, 5,000, 4,000, some mysterious alarm goes off and HMRC pounces. People repeat these figures with such confidence that they start to sound like law. Very often they are nothing of the kind. There is no single public tax rule that says one bank deposit over a set figure becomes taxable, and there is no one tidy number that turns an innocent person into a tax target overnight. What banks and regulators care about is pattern, risk, and whether the activity makes sense for the customer. That is very different from the pub story version of the rule. This matters because some people confuse bank anti-money laundering controls with tax law. They are not the same thing. For example, banks have been told to monitor suspicious cash patterns carefully, and some cash deposit limits through the post office have been tightened to reduce laundering risk. But a fraud control limit is not the same thing as an HMRC tax threshold, and mixing the two up causes endless worry. So here is your second phrase: no magic number, only a matching story. If the amount fits your life, the paperwork fits the amount, and the explanation is honest, you are in a far stronger position than someone hiding behind a small figure. A small unexplained deposit can raise questions too, if it keeps happening and nobody can explain it. That is why trying to stay under a made-up number is not a clever plan at all. It is much wiser to focus on whether the money is legitimate, whether tax has already been dealt with, and whether you can show where it came from. If you prefer money guidance without the shouting and the scare tactics, subscribe and stay close to the channel. The second rule is that numbers matter less than the truth behind them. Third, cash is where ordinary people often get into avoidable trouble. Not because cash is illegal, because it is not, but because cash tends to come with thin records, old habits, and fuzzy memories. And fuzzy memories look far less innocent when someone official asks you to prove what happened. Think about how many older adults grew up in a world where cash was normal for everything: little jobs done for neighbors, a few sales at a car boot, bits and pieces sold after a house clear out. Maybe some money kept in a drawer for years and finally paid into the bank after a clear up or a bereavement. Now here is the hard part. If your records are weak and there are unverified sums floating around, HMRC can ask questions. Their own guidance says private bank statements can be reasonably requested when needed to establish the correct tax position, and their manuals also show they can seek bank records such as account details and deposit records when checking someone's position. That does not mean every honest person is under attack. It means the paper trail matters more than many people realize. So your third phrase is this: paper trail beats panic. If cash goes in, make a note the same day. What was it? Where did it come from? Why was it yours? And what proof do you have? A dated note, a receipt, a sale message, a photo of the item sold, or a simple family loan note can save you hours later. If these practical little protections are the sort of thing you want more of, do subscribe and let me keep doing the worrying in advance for you. Fourth, gifts, family help, and inherited money often create fear where there need not be any. A daughter sends money to help her mum replace a boiler. A brother transfers money after a house sale in the family. A widow receives money after sorting out an estate. The deposit feels large, but large does not automatically mean taxable income. In plain English, a genuine gift is not the same as earnings. If your sister gives you money, that is not wages. If you inherit money, that is not the same as being paid for work. But this is where people must separate income tax from inheritance tax, because they are different parts of the system and they get muddled all the time. For inheritance tax, gifts can matter later, especially if someone dies within 7 years of making them. There are also allowances people often forget about, including the annual £3,000 gift exemption and the small gifts rule for gifts up to £250 per person. There are also special rules for regular gifts out of normal income, but the key point is simple. Gift money needs gift notes. Let me give you a real-life sort of example. Margaret is 68, widowed, and thinking about moving closer to her daughter in Leeds. Her sister sends her £12,000 to help with the move, because they had agreed years ago that if one of them was left alone, the other would help. Margaret nearly refuses to bank it because she is frightened HMRC will think she has hidden income. Instead, her daughter helps her do the sensible thing. They keep the bank transfer record, a short signed note saying it is a personal gift, and a message trail showing why the money was sent. No drama, no guessing, no panic, just a clear story attached to the deposit. That is how ordinary families protect themselves without doing anything fancy. So, if a family transfer ever lands and your heart jumps, slow down before your imagination runs away with you. Ask one quiet question. Is this income or is this support, a gift, a repayment, or part of an estate? And if you want more calm explanations like that, subscribe and keep the channel on your side. Fifth, some deposits are perfectly ordinary and still lead to honest tax problems. This is where people say, but it only went into my bank, as if the bank account itself somehow made it harmless. Savings interest is a classic example. So is a pension withdrawal that feels like your own money coming back to you. Many people can earn some savings interest without paying tax on it. If you are a basic rate taxpayer, your personal savings allowance is usually £1,000. If you are a higher rate taxpayer, it is usually £500. Some people with lower other income may also get a starting rate for savings of up to £5,000, though that reduces as other income rises. That sounds comforting, and for many people it is. But when the allowance is exceeded, the interest does not become invisible just because it arrived quietly in your account. Banks and building societies give HMRC annual information about interest paid or credited. That information helps HMRC adjust tax codes, issue calculations, and check whether returns are complete. So when someone says they will never know about my savings interest because it just drops into the account, that is simply not a safe assumption. If you are employed or getting a pension, HMRC may collect tax through your code. If you are not in self-assessment, your bank can still report the interest figure at the end of the year. And if you go over your allowance and hear nothing by the end of March after the tax year, you are meant to contact HMRC. Pensions create a similar kind of confusion. Yes, you can usually take up to 25% of a pension pot tax-free, but the rest can be taxed, and taking a larger amount in one go can push you into a higher tax band for that year. A pension deposit is still your money, but parts of it can still carry a tax consequence. I have seen people get a real shock here. David, aged 61, takes a decent lump sum from his private pension, sees the money land in his bank, and thinks the hard part is over. Then he notices the tax taken and assumes someone has made a mistake because he thought pension money was just his own savings. Part of it is tax-free, yes, but not all of it, and sometimes emergency tax can make the first payment look even harsher than expected. So your fifth phrase is this: harmless money can still be taxable money. The fact that a deposit feels ordinary does not decide the tax treatment. If this sort of steady untangling is useful, go on and subscribe, because this is exactly where quiet mistakes turn into expensive letters. Sixth, and this one matters more than people realize, fear itself can make you dangerous to yourself. Once people get nervous about HMRC, they become much easier to trick. They click links they should not click. They answer calls they should not answer. They move money they should never move. Scammers know exactly how to press that button. Official guidance says a suspicious contact may rush you, threaten you, ask for personal details, tell you to transfer money, or promise a refund, tax rebate, or grant. Those are not small warning signs. Those are huge warning signs, especially if the message arrives out of the blue just after you have been worrying about money. One of the nastiest tricks is the false sense of urgency. You are told there is a problem with your account, a tax issue, or a transfer that must be fixed now. You are told to move money to a safe account or to confirm details by text or to act before legal action starts. That is exactly the moment to stop because pressure is part of the trick. There is another version too, and it catches decent people who think they are helping. A payment arrives. Then somebody asks you to forward it, withdraw it, or pass it on for a fee. That is the sort of pattern the regulators warn about in money transfer scams, and it can turn an ordinary person into what is called a money mule without them realizing it. In simple terms, that means your bank account is being used to move dirty money. So your sixth phrase is this: stop, verify, then move. Do not trust the name on the screen. Do not trust the panic in your chest. And if you value having one place online that tries to keep you calm while everybody else seems to be shouting, subscribe and let this be that place. Now, let me pull the whole thing together. What HMRC does not make plain enough, and what many people only learn after a fright, is that a bank deposit on its own tells only half a story. Money paid in can be wages, gifts, savings, interest, pension cash, estate money, repayments, or sale proceeds. The treatment depends on the source, the records, and whether tax was due before or after it arrived. That is why the most useful habit is not fear, it is a tiny money ritual. Whenever a larger deposit lands or a cash payment goes in, pause for 1 minute and ask yourself 4 things. What is this? Where did it come from? Is any tax due? And what proof would I show if somebody asked in 2 years' time? If the answer is clear, write it down. If a document exists, save it. If it was a gift, note who gave it and why. If it was a sale, keep the message, receipt, or photo. If it was pension money, keep the provider paperwork. That is not paranoia, that is adult self-protection. And please do not make the mistake of thinking this only matters to wealthy people. Some of the worst trouble lands on ordinary people with ordinary finances because they assume nobody will ever ask them anything. The system is often much kinder to people with simple records than to people with complicated explanations and no paperwork. Clarity is not just tidy, clarity is protective. There is another quiet truth here as well. Many people over 55 were never properly taught how modern money checks work. They know how to save, they know how to budget, they know how to stretch a pension, help family, and get on with things, but they were not given a handbook for a world of app alerts, digital trails, tax codes, and scam texts. So if any of this has felt embarrassing in the past, please let that embarrassment go. Not knowing a rule is not a moral failure. What matters is learning it before fear, confusion, or bad advice costs you real money. That is what this whole channel is here to do, one plain conversation at a time. And if there is one person in your life who would sleep better after hearing this, maybe a parent, a neighbor, a friend from work, or a brother who still trusts every text he gets, send this video to them, not as a warning in a dramatic way, just as a quiet kindness. Sometimes the most useful financial help is simply passing on one clear explanation at the right time. I want to leave you with a picture you can carry around in your head. Think of your bank account like the front door of your home. All sorts of parcels come through that door over the years. Birthday presents, grocery bags, letters, repairs, flowers, and the odd box you forgot you ordered. The trouble is not that a parcel arrived. The trouble starts when the parcel has no label, no sender, and no note saying what it is doing there. A clear label lets the parcel sit quietly in the hallway. A missing label makes everybody stop and ask questions. Your job is not to fear the door. Your job is to keep the labels. So the next time money lands in your account and your chest tightens, remember the central theme. The deposit is not the story. The source is the story. Keep the story clear, keep the proof close, and you give yourself something precious in later life. Not just compliance, but peace.